Thanks, Simon, and thanks to everyone for joining us. I hope you're making lots of use of webinars and all the educational stuff that's getting put out at the moment. But thank you, Simon, for inviting us to join the Standard Bank online webinar. My name is Chris Rule. I head up product and client solutions at CoreShares. CoreShares, for those who don't know, is an ETF provider on the JSE. We've been around the market for a while, and we are trying to do all the good things to help guys have the best possible investment universe and the best ETFs. But today we're talking about something that may start off seeming a little bit theoretical in unpacking beta benchmarks. In other words, and I'll dive into the detail, but I'm going to bring it right back to the reality of how important it is for investors. So, what is a benchmark? A benchmark is an index, and of course ETFs track indexes, so they become very important and very practical from an investment perspective. But what's really interesting when we look at indices in South Africa is we see this massive universe of what would be considered a standard benchmark. To contrast that, if you say went to USA equities, everyone just talks about the S&P 500. That's the de facto US benchmark. If you go to the UK market, people talk about the FTSE 100, so on and so forth. But if you're in the South African market, we hear a lot of different indexes, and we hear about a lot of different benchmarks. We hear about the all share typically on the radio. We see SWIX coming up more and more, or the shareholder weighted indices. We hear about the top 40. We hear about the SWIX 40, and more we're starting to hear about capped versions of them. So SWIX capped, top 40 capped, Aussie capped, so on and so forth. And now, even more so, we're hearing, as S&P has built its brand in the market, S&P versions, the S&P composite, and the S&P 50, SA 50 index. So there's a lot of indices, which makes it quite difficult as an investor to know exactly what you're buying if you're buying an ETF that's linked to a particular index. But we thought we'd go back a little bit and just unpack why there are so many indices and the evolution of the indices in South Africa. As I mentioned, in the US, it's simple. If you're buying US equities, large cap, buying the S&P 500. But in South Africa, it's very different. And it's different not just for investors buying ETFs, but it's also very different for pension funds. It's very different for active managers who are trying to find a benchmark which they should be measured against. It's a massive problem in our markets. But what happened was, prior to 2002, the JSE had a JV with the Actuarial Society, where the Actuarial Society was creating indices. Then into 2002, and the FTSE, who is owned by the London Stock Exchange and is an index business in the UK, did a JV with the JSE to say, we will calculate and work out all your indices so that you've got a very credible index business backing your broad benchmarks or your market indicators, if you will. And with that, they introduced like the all share index we're familiar with, top 40 index, so on and so forth. So really, the JSE just said, we're going to leverage all this index firepower at FTSE to create a whole lot of indices. Now, what this meant for us is that suddenly we've got an introduction of a new index. And so at this time, the top 40 and the all share, those were the kind of de facto indices. But at the same time, there were massive problems. There was problems around concentration. Interesting, we're dealing with a Naspers concentration problem now, and I'll circle around to it. But all the way back then, the concentration problem was around two things. It was around a sector. That sector was the mining and essentially the resources sector, where we had BHP Billiton and Anglos making up a massive proportion of our market. And so we really had a massive concentration issue in the all share and top 40 indices. So the FTSE JSE, in collaboration with all the big asset owners, so the big pension funds and asset managers, started looking at a way they could address this concentration problem. And the reason why was they were essentially saying it's not reasonable for an index or a fund to have, say, 50% of two shares, Anglos and BHP Billiton, and 60+%, up to 66% in one sector. And they did a lot of work. And what was interesting was they introduced two new index series to deal with concentration. They introduced one which is called the SWIX. Now, the SWIX index is an abbreviation for shareholder weighted indices. And essentially what that does is it looks at the South African shareholder register, and rather than just weighting shares by free float size, it adjusts it for the local shareholders. So in other words, the dual listeds, BHP Billiton, Anglos at the time were the big culprits who had large offshore holdings because they were listed on the London exchange and in Aussie exchanges and so forth. They would be down weighted in our local market. So they introduced the shareholder weighted indice. They also, what's very interesting, is introduced a capped version of the all share all the way back in 2003. So capped indices actually, in theory, have been in existence for 17 years in our market. Now, what happened at this point in time, and why we started using the SWIX index more and more as an investment professionals, is essentially there was a whole lot of meetings and gatherings with the institutional market and the big asset owners and asset managers, and they all said, we actually think SWIX is the best solution to deal with concentration in our market. Now, what's very interesting and where this was flawed is that SWIX was a particular way to address concentration when it was being driven by dual listed shares. At no point during this investigation did someone consider that share without a secondary listing that would become so big that we'd have a concentration problem. The SWIX was the solve for concentration problems until, of course, Naspers came along. Naspers being a JC listed business, of course, buying into Tencent in China, but still through a primary listed and single listed JC share, and that became a massive concentration problem that SWIX could not deal with. So, I mean, in many respects, and hindsight is a perfect science, but the decision to start migrating indices to SWIX was a flawed decision because it didn't deal with concentration explicitly. It dealt with concentration at a point in time. So in other words, it dealt with concentration from dual listed shares. No one went with the Aussie Cappy, which is very interesting because that's actually an explicit way of dealing with concentration, certainly at a share level and as a function thereof at a sector level. So, I mean, I'm going into quite a bit of detail and you'll see why, but fast forward, say, to 2014, and S&P entered the market and they introduced their whole broad spectrum of indices. So the composite index, which is like the all share, and the top 50 index, which is kind of like the top 40, but with an extra 10 shares, and we'll go into the details. But they entered the market and created even more confusion in many respects and more noise. Then 2016 or so, and we saw that the SWIX concentration was becoming a problem. Interesting, back in 2003, no one introduced a SWIX capped version because they thought that SWIX was actually going to deal with the concentration risks of the market, but no one introduced a capped version of SWIX. So all the way back to 2016, the first SWIX capped versions came to fruition. So what this means for us as investors is a lot of confusion. But we thought we'd take it back just one step. What is a benchmark all about? And I'm going to just briefly like fly over some of the things, like it being relevant and measurable and unambiguous and representative, but most important, it should be investable. And that means essentially that a passive fund can track it. Now, why that's important is, as an investor, your starting point should always be the index. You should always say, okay, I want exposure to South African equities. Can I do better than that by either buying another active manager, Coronation, Allen Gray, you name them? Can I do better by stock picking if you're in an online stockbroking environment? And if the answer is without a whole lot of certainty, you should be starting with the index and buying an ETF that tracks that particular index. But the problem is that we see a lot of indices that are actually not relevant. So like a general equity benchmark, which a lot of funds use, and you can see it's the most popular benchmark, you can't practically invest in that as an investor. So we don't believe it's reasonable. But what we see, and the point of this webinar, is a huge fragmentation across these different indices. We've got all share SWIX, we've got capped all share, we've got the all share, we've got the capped all share, we've got the SWIX 40, we've got the uncapped SWIX 40, etc. And these are actual numbers and proportions of how many people are using these particular benchmarks. Now you're probably thinking, okay, Chris, why is this relevant? Like, you know, we are online investors and we buy ETFs and listed securities. We don't really go and buy active funds. But why it's important is because when you're looking at the difference between passive funds, you really need to unpack and understand, you know, the difference between a SWIX 40 and a top 40. And I'm going to show you as we go further on, there are some major bets you're taking when you're buying a SWIX 40 ETF over a top 40 ETF or a top 50 ETF over a top 40 ETF and so on and so forth. So, you know, this stuff really is important. What's interesting, and I mean, we see this time and time again, and it's really consistent. I'm putting together numbers now on the latest SPIVA, and SPIVA is a report of active versus the index. To beat these indices. And as a function of human beings generally struggle to beat indices. They're very difficult benchmarks to beat, and ETFs as a function there. So the red line at the bottom, you'll see is the average of our active managers. And then these lines at the top are all of these different benchmarks that you're investing in here. So what we're saying is that really, you know, first prize is just to make sure you've got an allocation to an index, to equities. But let's go into the universe of our indices, and as a function thereof, the universe of our ETFs. And now there is a top 40 ETF, there is a SWIX 40 ETF, and there is a top 50 ETF. If you go into the unit trust world, where I'm sure a lot of you invest in as well, you also get all share in unit trust, you get SWIX all share unit trust, you get SWIX capped unit trust, SWIX 40 capped, and so all of these are actually investable strategies, and as an investor you can actually go out and buy them. So we wanted to start off with probably the most widely referenced stuff, and that's the all share indices. The all share indices are the broad market coverage, so around 160 shares on average. It changes from time to time on the periphery, but basically 115, but 60 shares. But what we see is massive concentration in these indices. So that little red line and with the number 22 next to all share is how many shares you have from a statistical perspective. So even though nominally there are 159 shares in your portfolio, because the top 22 shares make up such a large weight, in reality you might as well just own those 22 shares. So it's quite inefficient from an investing perspective to go out and buy 159 shares when you're only getting exposure to 22. So, you know, what we see is a very broad representation of the market, but actually you're mostly getting exposure to the 22 largest shares in our market. The big thing to note here is what's interesting is the SWIX looks quite different when you cap it. So when you cap the all share, you pick up your effective share exposure, so you improve diversification. The higher this number is, the better your diversification is. And the thing, but you actually improve diversification quite a lot. So what that means is that from a distribution of shares perspective, we've got quite a different portfolio, quite a different index. Excuse me. There we go. Risk and return stats, you don't see a massive difference. We do see probably the most notable differences when you go from an all-share SWIX or others to a capped SWIX version. We see the Sharpe ratio dropping off quite a bit. But in general, what we're just trying to show you is that they're quite similar from a risk and return perspective. But where they are different is from sector allocation. Now, this is point in time, so this is the most recent sector allocation. And what we see is a function of those discussions that I introduced to you all the way back in 2003, where there was concentration around materials because they were all dual listed. But what we see is when you're buying all share and you're moving towards SWIX, you're actually making a bet underweight materials. So you're saying, oh, I like SWIX because I don't want to hold materials, and you want to hold financials more so. So you're taking an overweight bet on financials and an underweight bet on materials. And that's the big bet you take at the moment when you're looking at SWIX. And consumer staples is the same. The reason why consumer staples has a pickup is because of Naspers. So financials is all our big banks, which are primary listed, and then the materials, which are dual listed, you tend to downweight. Now, this kind of is intuitive based on what we've been talking about. So if we roll forward and we look at our large cap indices, and now these are the most relevant for the ETF world and for the investing world, because this is, you know, almost without exception, you can buy an ETF which tracks one of these indices. What we see is that, yes, you hold less shares, so you're holding around 40 shares, or in the case of the S&P 50, 50 shares, but you're actually getting a far more efficient portfolio, because yes, you're buying 43 shares, but you're getting exposure to 16, as opposed to buying 160 and only getting exposure. When we cap it, we see a big pickup. So your effective share exposure goes up to 19 in the case of the top 40, and to 27 in the case of the SWIX 40. The S&P 50 is a slightly different animal, and we'll go a bit into it later. We have an ETF that tracks it, so I would like to spend a few minutes just taking you through why we like that index from an investment perspective, and why we chose it to track the index. But essentially, what you can see is we still have a broad market coverage, 84% on odd from those 40 shares. So you can see buying the extra 120, you're only getting another 15% coverage. In fact, the 50, which just picked up from 40 to 50, obviously the extra 10 shares takes you up to 90% coverage. So it's an efficient allocation. And what we notice here is that it's far more efficient from a portfolio perspective. We're buying 40 shares, but we're getting exposure to a lot more. Again, the one thing to notice on risk return, all pretty similar, but when we cap the SWIX, we get suddenly we get quite different behavior. And we'll talk about that a little bit further down the drag. So the sector stuff looks similar to the Aussie. So again, when you're moving from an all-share free-floated weighted methodology to a shareholder weighted methodology, you're suddenly taking a bet underweight materials, overweight financials, and overweight consumer staples. So, you know, you're making big bets. Is rather not, this is all point in time, but is this a structural bet you're taking? You know, are you making a bet here as a long-term investor? So we wanted to unpack that, because what we've noticed here is that really the big bet you're making is when you're choosing between shareholder weighted index, SWIX index, or free float weighted, like all share or top 50. So we wanted to unpack that. And really what we see here is, yes, their correlations are all relatively high. We see all the free float weighted indices, so all the all share or derivatives thereof, the top 40, the top 50, etc. Very high correlations, 99. The minute we go into shareholder weighting, those correlations tend to drop down somewhat. And why is that? So what we see is a structural deviation when we're choosing a shareholder weighted index versus when we are choosing a free float weighted index. So if you're buying the SWIX 40 ETF versus you buying a top 40 ETF, you're actually making a structural bet. You're saying, I am bearish on basic materials, which is resources, and I am bullish on financial services. And as we can see, this is pretty structural through time. This is quite consistent through time. So you need to be aware of the kind of bets you're making when you're picking between two ETFs like that. And the biggest bet probably is the structural offshore bet. Now, it's very intuitive to think, if we are going to be reducing the weight of our dual listed shares, we're going to be reducing the weight of our Rand hedge component of our portfolio. So if we look at top 40 versus top 40 SWIX, the top 40 SWIX is a long-term structural bet on South Africa incorporated businesses. As well as some look through in terms of underlying shares. So you're actually making a bet on the SWIX. Now, what's really interesting, and this is anecdotal, but a lot of fund managers who moved their funds to benchmark against the SWIX, they were simultaneously bearish on South Africa. So in other words, they thought, yes, the best opportunity to invest is offshore. South Africa's got all these problems, political, structural, Eskom, credit rating downgrades, etc. But then they moved their fund to benchmark against an index that was actually making an overweight bet on South Africa as opposed to the all share. So know that you're making a bet on South Africa when you're buying shareholder weighted indexes. Know that you're making a bet on financial services and South African incorporated stocks, and an underweight bet on basic materials or resources. And this comes out in some quite spectacular return deviations. So this is a problem for, especially for advisors. They've told their clients, okay, sorry about the last 5 years. We've been in these active modes and they've underperformed the index. We're going to move you into the SWIX 40. Into the SWIX 40 you go, and the client's driving home from work and they hear on the radio, the top 40 is up 8% for the year, and everyone's happy. You go back and you meet your advisor and you look and you've actually flat for the year. You're 8% behind the top 40. And that's because of some of these bets. So this blue line is the rolling return deviations on a 1-year basis. And you can see it becomes quite significant over time. So it really does play out in terms of the noise of your portfolio, so on and so forth. And again, from a holdings level, we then did a holdings level attribution over, say, 15 years to understand where was the contributions to return. And what's really interesting is that the top 40 outperformed the SWIX 40, not hugely so, but it did. And the biggest contribution to almost over the last 15 years was actually mining stocks or resources, materials. And now most people would think that's counterintuitive. They would think resources have done so poorly, but actually if we look out of the short term into the long term, the biggest contributor to the outperformance of the top 40 relative to the SWIX 40 and the ETF is materials. This is also really interesting. So beyond just the sectors, if we look at the share allocations and the contribution to returns, now just to take a step back, the top 40 is taking an overweight position on BHP Billiton and an underweight position on Naspers relative to the SWIX 40 because of some of the stuff we've spoken about earlier. The funny thing is that we've only heard about Naspers in recent history and how it's so hard to create a portfolio because there's so much concentration and it's performed so well, so you can't beat the index. But actually, the top 40's contribution to return, if we decompose that at a share, in BHP Billiton, less so than its underweight position in Naspers. So actually, its overweight position in BHP Billiton was a better bet than being underweight Naspers. Now, you probably haven't heard that for a while, but over the last 15 years, these are the return attributions. So really, what did we want you guys to get out of this? We wanted you guys to get out of it that when you're picking an ETF, a top 40, a top 50, or a SWIX 40, understand that there's a big difference out there. When you look at shareholder weighted indices, you're taking big bets on financials, on SA Inc. When you're and a big underweight bet on materials. Apologies. And interestingly, if you Google shareholder weighted indices, if you Google, I mean, we're not a fan of shareholder weighted indices, but if you Google them, you won't find them anywhere else except for South Africa. South Africa runs the only shareholder weighted indices in the world. There's no evidence as to suggest why it's an efficient way of allocating capital, so on and so forth. It's just was kind of an ad hoc approach. At CoreShares, what is our beta of choice? There's been a whole lot of noise here, top 40, top. We like the top 50. We like the S&P 50 for a number of reasons. And we have an ETF that tracks it. It's got some 1.5 odd billion rand in clients' money tracking it, and it has been a popular choice for a number of reasons. All the way back in 2014, when S&P came, we wanted to launch this index with them. It looks at 40 shares, not 50 shares. Now that extra 10 shares sounds random, but I showed you the market coverage goes from say 84 to 90%. So it is meaningful. And what that means is we get more exposure to the smaller, more of the mid-cap exposure, which makes up around 5% of the portfolio. Importantly, in our market, and we believe the best to control for concentration is through capping. And it has a single stock cap of 10%. So it's really simple. It's the 50 largest shares weighted by their market cap, free float adjusted, with a 10% cap. That's it. It's rebalanced quarterly. And you can see the impact of a cap. So we've got the SWIX 40 index, the largest cap, 22%, and then the top 50. So you see a far more even distribution of shares, which leads to greater diversification. And then you get that little pickup of around the extra 10 shares, about 5% of the portfolio. You see the diversification pickup when you're buying the top 50 relative to top 40s uncapped. And we would expect that because the cap is an explicit control for diversification. Now, what you're probably thinking, well, is that by capping, do we not miss out on the upside? Because Naspers has run so hard, we're missing out on the upside. So if you look at the top 50 CAT index versus the SWIX 40, we can see over a 13, 14-year period through GFC, global financial crisis, by capping a share, you're not missing out on the upside. It's just good risk management. All of this, there will be noise in the short term. Now, again, all of this stuff is indices. In reality, what does this mean? Well, you can go and buy an ETF that either tracks the top 40, the SWIX 40, or the top 50 for that matter. But does it give you the index? And what we're trying to show you here is that index houses and CoreShares, of course, being an ETF house, but there are many other, Satrix, Stanlib, so on and so forth. They've become really good at tracking indices. There's not much return difference between an index and the actual ETF that you buy. So you can see how tight the tracking area is there. Last year we won a Salter Award for tracking efficiency. This year it was won by another ETF house, but it's so competitive now. It's literally being divvied up by the basis points. So we're not even talking about 10 or 0.1% or anything. It's basis points. So this gives you an idea of how close you can get to the index. Over 3 years, the index and the fund are virtually aligned. So those kind of horror stories about tracking error and you can't get the index. This is really important from a benchmark perspective because the benchmark must be investable, and if it's investable, then the fund will track it very efficiently. So Simon, that just about wraps it up. I'm around to take any questions. I did hustle through quite a lot of slides quite quickly, so apologies if it was a bit rushed. But we really think that in our travels, there's been a lot of kind of nonchalant responses to us as a passive business when we've said, hey, what's your choice? And look at us crazy, like, well, we SWIX 40, and we would say, but have you understood why you're buying the SWIX 40? Do you understand the bets you're making relative to top 40, relative to ALSI and so forth? And we found overwhelmingly that the market, and not just the online trading market, but the professional fund buyer market, institutions don't really know what they're buying when they're buying SWIX 40 versus top 40. And so actually this presentation we've done to the institutional market, and it's been very well received over the last 2-3 months. So, we thought we'd bring it into this environment to help clients understand ETFs and unpack their ETFs that are available to them.
Chris, really appreciate proper nerdy for a Friday morning. I love it. A couple of questions coming in. Mark is saying a lot of issuers in South Africa. By comparison, how many US issuers are there of ETFs? Chris, I'm not sure if you know. I found a link, which Mark I'll send to you now, which suggests there are perhaps a couple of hundred issuers in the US.
Yeah, Simon, I was going to say, if we've got 8 ETF issuers in our market, and some of those issuers even come out of the same stable. So like, ABSA's got an issuer that does their commodities one and then the equities one. So it's realistically even less. In the US, it's certainly north of 100 issuers of ETFs. The big brands dominate. So Vanguard and BlackRock and PowerShares and ProShares, Wisdom Tree, these big brands dominate. But there are literally hundreds of ETF issuers. You could almost parallel it to how many in our market. If we think there are a lot of ETF issuers, we should look at how many active asset managers there are. And we'll see that actually ETF issuers are hugely underrepresented. I don't know the exact number, Simon, maybe you do, but it's certainly north of 100 as well.
Yeah, I found a link on ETF database. The top 10, I mean, I didn't even know of all of the top 10. I mean, Van Eck I hadn't heard of, First Trust I hadn't heard of, JP Morgan, and this is running on assets under management. JP Morgan's in 10th, and that surprised me. As you said, iShares, Vanguard, the big guys up there. Certainly. A question from Fred, and I'm glad he asked it because it's one of those things I kind of know, but he says, you mentioned on slide 9, Sharpe ratio. What is a Sharpe ratio? What does it indicate? How should it be interpreted? And I know we could spend an entire MBA course on this, but...
Yeah. It's actually, I mean, I wish we didn't have all this lingo, but all Sharpe ratio is how much return you are receiving per unit of risk. So in theory, you want to get the most possible return per each unit of risk. So what you want is a high Sharpe ratio, because a high Sharpe ratio means that you're getting more return per unit of risk you're taking. And that's really as simple as it is. Another way of saying that is it looks at, so if you're taking loads of risks and getting kind of average return, that's probably worse than taking very little risk and getting and getting average return. So, even if does that make sense, Simon?
Yeah, so it's kind of a risk return type scenario, and what you want to stay away from is the high risk space, even if it's going to offer that high return, because you can get a much more sort of comfortable in the sort of what be the middle or lower tiers of the chart.
100%.
Yeah.
And it's a way of seeing that you're being rewarded for the risk you're taking.
A question, Chris, wasn't in your presentation, but a question coming through. Someone saying that they hold your offshore property ETF, and their question is, are they benefiting from the weakness in the currency? The answer is absolutely they are.
Yeah, short answer is absolutely. I mean, obviously global markets have sold off hugely over the last, well, basically since 24th of Feb, so a month and a bit. Interestingly, the global rand-based funds haven't moved that much because the rand has weakened so significantly. So
Yeah.
you've got buffered by the rand movement, but in reality, in dollar terms, your investment has gone down. That is a reality.
Yeah. Cool. We'll park it there. I'm not seeing any more questions coming through. Chris Rule, CoreShares, really appreciate your time this morning. Ladies and gents, appreciate your time. What are we? Day 8 of lockdown. We'll be back Monday, 10:30. Myself and Danea will be talking markets, local and global, what's happened, what we're looking for in the week ahead. Of course, next week, a shortened week with Friday and then the following Monday being holidays for Easter. But as I said, we'll be back on Friday. And we're going to shift our Friday and Monday presentations to Thursday and Tuesday. So we won't present over the weekend, but what we will do is we'll still have the 3 a week as we ramp up. Ladies and gents, Chris, everyone, really appreciate the time. Cheers all.
Thank you, Simon.